Hi everyone, I'm Neena Mishra, ETF strategist at Zacks, and I'm here to talk about the fundamental view of the market. And it's been an amazing year for the market, and fundamentals still look good in my view. So the S&P 500 is up about 21% year to date. Nasdaq has risen more than 19%, and the Dow has returned about 18% year to date. And all three major indexes are now at or close to their all-time highs. Now looking at sectors, all sectors are in the green. Energy is the best performer, and financials is the second best performer, but that is mainly due to their excellent performance earlier this year. So the rally earlier this year was driven mainly by cyclical, economically sensitive areas of the market. But over the past few weeks, we have seen that growthier stocks, particularly mega cap tech, they have done very well. Now, recent economic reports have been mixed, but not bad. Economy continues to grow. But earnings reports have been very impressive. Most of the companies, they have been beating on the top and bottom lines, and profit margins are at record highs. So I think that economic growth, record earnings, and ultra low interest rates will continue to support this rally. Now, the jobs report for the month of July that we got past Friday, that was much better than expected. The economy added almost 1 million jobs, and the unemployment rate dipped to 5.4%. And this is the trend we have seen over the past 2-3 months, and remains to be seen whether this trend can continue as we head into the fall months. Now, some experts caution that these kind of job gains will force the Fed to start tapering, but I think the Fed will wait for a few more months. Now, going forward, there are two main risks for the market, I think. And number one, the Delta variant of the coronavirus, which is spreading fast, and rising inflation that could also impact recovery and negatively affect stocks. Now, I'll talk about inflation in a bit more detail in the agree to disagree segment. But talking about the Delta variant, I think the US is in a much better position than the rest of the world, because we have seen that other countries are still struggling. Many other countries are still struggling with either vaccine rollouts or another wave of infections. So in fact, international investors worldwide, they have been pouring billions of dollars into US domiciled exchange traded funds and mutual funds. And there is so much cash still on the sidelines that investors, either international investors or US investors, they continue to buy on dips. Now, which area will perform better going forward, that really depends on the path of the virus. And since the path of the virus cannot be predicted, we do not know how the Delta variant is going to affect the economic recovery and reopening here. So it is better for investors to invest both in secular growth and cyclical value stocks. Buy high quality companies and ETFs in both these areas and stay invested.
All right, everybody. Dave Bartosiak back here again with our technical outlook for the market. Now, let's start all zoomed out just to give some perspective when you're feeling down, when you're feeling lonely. Remember those lows on the S&P 500 following COVID, the post-COVID low down near 2,200, and we have doubled off of those post-COVID lows. So don't feel so bad. It's been one heck of a ride. Now let's go ahead and zoom in here. And we're actually, before I zoom in, I want to just point out this blue line is the 50-day moving average. Now note how the S&P 500 has bounced on that 50-day so many times. For those of you who don't think the 50-day matters, I enter Exhibit A. Okay, several times along this move higher, 50-day has been the one that's come into play. And there's been so many times we were worried that 200-day would get tested. That 200-day has not been tested since June of 2020. Feels like eons ago because, well, it was. But now let's get a little bit closer look at what's been happening recently, because it just feels like we're this slow grind higher. And if you feel that way, it's because it is, right? We're not getting these huge spikes up or breaking out. We're really teetering, pushing up at the edge several times here on the S&P 500. But the good news is, all the while, we are making a little bit of progress higher. Let's look at a little bit of a higher beta index. That is the NASDAQ Composite, and a very similar theme, 50-day moving average coming into play, although NASDAQ behaves a little bit differently. It sort of overshoots this 50-day often, right? It has a tendency to do that versus other indexes that just sort of bounce off it, like the S&P, right? This kind of overshoots. And so when you get this action like we had in May, where everybody was freaking out because the market was under pressure, tech was under fire, and everything looked like it was going to zero, all of a sudden we catch a nice little rally, and here we are again, all-time highs. Hard to be upset with all-time highs. Now, one thing that I did with the most recent Zacks Confidential was I took a look at individual sectors. So in this case, I've got the XLE, which is the energy sector. Now, energy's had one heck of a move. Then this is going to differ a lot from the broad market, right? So I'm just kind of highlighting some of these highs and lows here, right, that we saw in energy. And now there's this downturn below the 50-day moving average, testing that 200-day, something you're not seeing on the NASDAQ, you're not seeing on the S&P, you're not seeing on the Dow. I mean, the list goes on and on. Now, what is this telling us? Well, maybe the huge move in energy, because we had a very dramatic move, right, just from November, maybe it was a little bit overdone, a little bit long in the tooth. So now it's sort of rolled over. So keep an eye on that 200-day moving average for the energy sector, trying to give folks an idea of what the next strong sector might be to catch a little bit of a bounce. So energy is one that I'm looking for. And you can look at several of these ETFs to give you an idea. So again, this is the financial sector. And note how this has been rocking and rolling. Again, under that 50-day just for a little bit, and then all of a sudden, now we're on the move again. So you can look at all of these, and what you'll find is only a couple of them are playing catch-up. And most notably, it's really energy. Here's the materials sector, right? Up to that 50-day, now we're coming underneath a little bit of pressure. And the last one I want to show you is the industrials, XLI. And again, same scenario. Gets to this 50-day moving average, it's just kind of moving sideways. So if we have a couple of them above, a couple of them right in step with it, as the broad market is going to new highs, I think the laggards will catch up. That's why I like to look at that energy sector. But overall, the market at all-time highs, rocking and rolling. The last one I want to look at, I'm going to use the IWM for the Russell 2000. And again, this shouldn't come as a surprise, but we've got this sort of consolidation happening in the Russell, okay? The Russell has two modes, sprint and rest. And after sprinting off the lows, I'm going to sort of zoom out here so we can see what I mean by sprinting off the lows. This move from the March lows more than doubled. Nice little sprint there, and now it's catching its breath. So give it a chance to catch its breath. 200-day to the downside. You can even see that this 50-day moving average, the slope is 0. It's moving horizontally. So 235, the breakout on IWM, 210, the lows. So I'd be buying down at 210, maybe selling into 235 each and every time that it happens. But that's my technical outlook for the market here. Enjoy the rest of the show.
Sheraz Mian and Neena Mishra agree to disagree right after this list of recent Zacks Ultimate top movers.
Welcome to Agree to Disagree segment. Sheraz Mian and I will discuss today whether inflation worries are overblown. And Shiraz believes that inflation will probably linger relatively longer than expected, and there is a risk that it gets entrenched. But you will hear from him in a bit. Let me give you my argument first. I believe that inflation is driven mainly by pandemic-related factors, and therefore worries about inflation spiking are somewhat overblown. And we are actually experiencing inflation in our daily lives. We know that cost of food items has gone up, cost of raw goods has gone up, cost of transportation has gone up, gas prices have gone up. And what concerned many experts was the CPI report for the month of June. So the CPI index saw its fastest rise since August of 2008. But digging a little bit deeper in the report, we saw that used auto prices accounted for almost 1/3 of the increase in the index. And this was the third consecutive month of big surge in auto prices because we know that global chip shortage continues to impact the supply of new as well as used vehicle. Now, the supply of new vehicles is going to recover once this chip shortage, the global chip shortage, has abated, which will in turn ease the demand for used autos as well. And as we head into the fall months, stimulus payments are going to be tapped out, and many people will not have so much savings to continue to buy stuff. And that is we have seen in case of lumber prices also. They saw a big surge and then they plunged when when there was more supply in the market. But that being said, the spread of the Delta variant, particularly in Asian countries, that may prolong the supply chain disruptions, and that may keep inflation at elevated levels for the next several months. So inflation could continue to rise for some more months before easing. But I think all these factors are driven by the pandemic, so not much to worry about. And over the longer term, we know that companies have been investing a lot in digitization and automation, and the impact of rising digitization and automation is going to be deflationary for the economy. Now we will get the CPI and PPI numbers this week for the month of July on Wednesday and Thursday respectively, and we will be closely watching those. And I will hand it over to Shiraz now.
Thanks, Neena. I would disagree with Neena in the sense that I strongly feel that as investors, we have to take inflation worries seriously. Inflation is one of those few variables. Interest rates, a direct relation of inflation and then earnings, that without having an outlook or a view on these variables, we are practically in the dark in our investment decisions and the choice of assets that are on our portfolio. So yes, any concern about inflation is never overblown in my judgment. And a related question to that could be that is the present time, the circumstances of the present time justify more concerns about inflation than the past, or less? And one could argue either way, but I think most of us would agree that in terms of excess liquidity in the system, a very expansive monetary policy, and free-flowing spending, government spending, the present time is unlike any that we have seen in the past 10, 15, even 20 years. So there are legitimate grounds for investors and all market participants to be concerned that there will be more inflation in the future than we have seen in the past. And while it's never possible to accurately forecast the magnitude or the timing of these things, but the ground reality or the circumstances should help us appreciate that it is a real a possibility, and then have our investment decisions reflect that. And those decisions aren't that we run away from the market, we sell everything and be in cash, but rather be in stocks and other assets that tend to hold up better to such an environment if it transpires. Personally, I don't think there will be inflation of the type that we saw in the past, particularly in the 70s, when you have high inflation and no growth, the stagflation kind of scenario. I'm on board and on the same page with how the Fed is characterizing the issue, and as Neena put it in her thesis, that it's some supply chain disruptions, COVID-related, that eventually will be evened out. And then on top of that, obviously, this excess liquidity question that I pointed out as well. But I think it's a legitimate worry, and I think all of us should be mindful of it and take investment decisions knowing that it's a possibility, and will only benefit from being that type of vigilance and concern. So that's my view on the inflation question.
Ahead of the Zacks mailbag is this list of recent Zacks Ultimate new editions.
Kevin Matras, and this is the Zacks mailbag. All right, I'm going to go over 3 questions today. First one, is it really possible that one could just invest in mutual funds and or ETFs and could pretty much forget about worrying about the fluctuations of the stock market? So the answer is yes and no. If you invest in an index ETF, your investment, of course, is going to track the market. It's going to track the fluctuations of the market to a T, both up and down. Now, if you are a terrible stock picker, that is most definitely the way to go. Now, if you get into mutual funds, those two are typically less volatile than individual stocks. But again, I would say if you are a bad stock picker, more than likely, you're probably a bad mutual fund picker as well. Same goes for specialized ETFs. But either way, those larger funds are typically less volatile than individual stocks. So if you're in an index ETF, you can be sure that you're going to get market returns and not lose more than the market when the market ultimately pulls back, like so many people do with high volatility portfolios or portfolios that have very high betas. But again, that also means that you are never going to outperform the market either. And if you're a decent stock picker, you can outperform the market in both good times and in bad times. So I would say it's very important to learn how to pick stocks. And that can help you in both bull markets and bear markets. But again, if not, index ETFs are a fine way to go. And in general, mutual funds and other ETFs are typically less volatile than individual stocks. Okay, next one. Is buy and hold better than to book profits and rebuy at lower levels? Look, I like pulling profits. Too many people will see a big winner, they will ride it all the way up, and then they will ride it all the way back down as well and have nothing to show for it at the end, or worse, they will have a loss. For me, when I get into a stock, I typically have a price target in mind. And when I reach it, I like to pull some profits off the top. I also like to use trailing stops so I can lock something in just in case the stock goes down. But if the stock keeps going up, which is the ideal scenario, you will keep making money as it does so. Now, in general, I like getting my original investment back because this way you're working with just the market's money. And when the market does go down, I do like buying more stocks, more shares, assuming I still have the same favorable outlook on that stock. Now, of course, if you start pulling shares off of your position as it goes up, just know you're not going to be that person who buys $10,000 worth of Microsoft or Amazon or Google and then turns it into $10 million by doing that. You won't be that guy because you keep on pulling shares off of your original position. Although it should be noted that there's not that many stocks out there that will be the next Microsoft or Amazon or Google. And most people probably wouldn't have the staying power anyways to be able to, put on a modest investment and ride it all the way up until it turns into this massive winner of $10 million. But by smartly pulling profits on the way up and adding positions on the way down, you can do very, very well. And you'll be able to keep your position size intact. This way, this is in regard to the overall portfolio, in regard to your comfort level, which is also very, very important, and in regard to your own personal risk tolerance. Okay, last question. I have been perplexed lately. It doesn't make sense to me that a company with style scores of A's across the board has a Zacks rank of 4. First off, I covered a similar question like this in last month's segment, so I would definitely tell you to go back and check last month's segment out. But the quick answer right here is this. The Zacks rank is the primary rating system which focuses on earnings estimate revisions. The style scores are a separate factor that is layered on top of each Zacks rank, whether it be a 1 or whether it be a 5. And regardless of the Zacks rank, 20% of those will have a style score of A, 20% will have a style score of B, 20% to C, 20% to D, and 20% in F. So a stock with a Zacks rank of 4, and let's say a gross score of A, for example, means that while it has a sell rating due to its unfavorable earnings estimate revisions, its growth attributes are within the top 20% or best 20% of all of the other Zacks number 4 ranked stocks. So in other words, these stocks have the best growth attributes of the stocks with the worst estimate revisions. These are the best of the worst, so to speak. Now, it also works the same way in reverse order, right? If you have a stock with a Zacks rank of a number 1 and a gross score of A, for example, that's essentially telling you that these are the best of the best stocks. Just remember that the style scores are important to help you select the best of the respective Zacks rank stocks. But again, the Zacks rank is still the primary factor. And in general, even stocks with a Zacks rank of 1 or a 2 and a style score of a D or an F have a higher probability of outperforming the market. But likewise, a stock with a Zacks rank of a 4 or a 5 and a style score of an A or a B still has a higher probability of underperforming the market. So just know that stocks with the best Zacks rank and the best style scores have the highest probability of working out. But again, definitely check out last month's mailbag segment for more detailed explanation of style scores and the Zacks rank. See you next month.
Sheraz Mian and Dave Bartosiak handle the portfolio makeover after these interesting insights from Zacks Ultimate editors.
Hi, this is Sheraz Mian with the Portfolio Makeover segment. Dave Bartosiak will be joining us. Dave and I both have picked one portfolio each that you guys submitted. The portfolio I picked, I have added to the Zacks.com portfolio tracker. Let's just go in and show you what I have on the Zacks.com portfolio tracker. So as you could see here, the portfolio I chose from ZU customer Raful A is here at the Zacks.com portfolio tracker. The beauty of Raful's portfolio, and what caught my eye, is that in the just 16 holdings, he's able to create a degree of diversification that many much bigger portfolios are unable to do. So what you could see here on your screen, you have Apple, you have Advanced Micro, American Express, Celestica, and there's a couple of others on the large cap side, Morgan Stanley, Microsoft, obviously Robinhood. Robinhood is young and new, but still a large company. And then you have a ton of small cap companies, a ton, again, in the context of a portfolio comprised of 16 holdings only. A lot of these companies, Celestica, Driven Brands, Flora Growth. I would put Flora Growth broadly in the cannabis space. Flora and Decor, obviously housing, Jack Pacific, more retail, and Tilly's, Wool Shipping, Genetic Biosciences in the pharma side, and a very useful ETF in the iShares Dividend Growth ETF. So you have a very nice blend of large cap anchor companies in 2-3 major sectors: technology, for example, financials. Morgan Stanley and Robinhood would fall on the financial side, and then it has a variety of small caps in faster growing areas of the market that should give him that aggressive growth type of orientation. If I have any issue with Raful's portfolio, which perhaps because of its size is holding him back, is the lack of more cyclical exposure. As you guys may have seen in the Agree to Disagree segment I did with Neena, I I would prefer investors to have some positioning in their portfolios that makes them well suited should the inflation picture turn out to be hotter than what the market is projecting. But on the whole, Rafold has done an excellent job in his portfolio. And with that, I'll pass it on to Deb Bartosian.
Well, thanks, Sheraz. And here I have another portfolio submission, this one from Eric A. Let's go ahead and dive in and see what we have here. So we have a mix of 13 different positions here. And a couple of things I want to point out sort of right away is we do have the Vanguard S&P 500 ETF. So I'm not going to comment too much on this. This is a broad market overall, right? So this is something that many people have in their portfolio, whether it be the Vanguard ETF or SPY or something like that, just so you get some exposure to the broad market. But here I want to look at individual stock ideas to sort of see, what sort of diversification do we have and what's the Zacks ranking is. So right off the bat, one thing I noticed is a lot of Zacks rank number 3s in here, okay? Now that's not necessarily a bad thing. Remember, Zacks rank number 3 means it's a hold. So overall, these aren't stocks that are seeing aggressive earnings estimates moving in a positive direction, but they're also not seeing it move in a negative direction. But when you see a Zacks rank number 5 strong sell, that means estimates are moving to the downside. So let's take a look specifically on this Two Harbors Investment Corp just to see what we're looking at. So Zacks rank number 5, strong sell right now. The REIT and equity trust industry, the bottom 17% of our Zacks industry rank. And also when you're looking at style scores, a C for value, an F for growth, F for momentum, VGM composite score of F. So in terms of Zacks rankiness, not exactly what you want to see. But I think the story here is really the dividend. I mean, you're getting 10.6% in terms of a dividend here. Now, I'm not going to comment on the safety of this dividend or what's going to happen in the future because I'm not 100% sure. Now, let's go ahead and take a look at the detailed estimates page on Zacks.com and see what happens with this stock. So, if you look at the revenues, sales estimates, this is where things get a little bit negative. You have contraction in the current year of 48%. Next year, expected to have more contraction on the earnings side, contraction, but there's some positivity at the end of the rainbow there. Now, where does this Zacks rankiness come into play? Why is this a Zacks rank number 5 strong sell? Well, look at the negative revisions coming from analysts. Over the course of the last 30 days, you have 2 analysts cutting their estimates for the current quarter, 2 for next quarter, 1 for the current year, and 2 for next year. The impact has been EPS going from 90 cents down to 73 cents for the current year, 95 cents down to 83 cents for next year. That's that sort of negative movement that you don't want to see, and that's why it's not in the good graces of our Zacks rank. So that's something I would address if this was my portfolio. The other thing I'm seeing here, you do have, I would say, bag holder name inside of here. Whenever I see something that is at 54 cents, odds are you got it a little bit higher and maybe it's run against you a little bit. There's not any analyst coverage that we have, so that's why we have the NA, right? There's just no rank for us, so hard for us to pass any sort of judgment on that individual name. But I'm getting the vibe here that this is income focused, right? Because we have this Realty Income Corp, we had innovative industrial properties, right? This infrastructure trust. So this seems to be a portfolio that's a little bit more geared towards the income side. But then on the flip side, you have some really aggressive names, right? So you have the Microvision inside of here. You had the Naked brand, which I'm sure was at one point an aggressive name. Rimini Street, I've seen them before. I think we almost had those in Blockchain Innovators even. You have Verb Technology. So you have some names that are a little bit more aggressive in here. Zekin, this is a name that was in Blockchain Innovators and had a big spike and then now has sort of come down. So I think if this was a portfolio that I was putting together, I would want to see a little bit more higher quality sort of names in terms of the income side. Maybe you're not going to get the dividends in the double digits like you're getting here. but you get something a little bit more consistent and you get some price appreciation over time. So think about blue chips, things like that. And we have services to help people out with that. We have the income investor here, which is something that you would love to, you should probably take a look at in order to give you some ideas of what some of the higher quality sort of income names are. And then on the tech side, we have some names in here that are really some home runs that you're thinking are going to pay off big time. But overall, you'd probably be better suited, or this portfolio in particular would be better suited, finding more large cap kind of tech names. And I think that are in the good graces of the Zacks rank, and that might result in something that's more favorable in terms of the Zacks rankiness, as this one's sort of middle of the road, a lot of threes, not a lot of ones and twos, and lots of speculation.
Here are a few things you can expect to see coming up. Our mobile app gives you access to real-time pricing data from BATS. You can also opt in to receive trade alert notifications and service updates for each portfolio you follow. Plus, be sure to check out the latest 5 stocks set to double report, which features 5 long-term trades our experts predict could deliver gains of 100% or more in the year ahead. And the next Zacks Ultimate Strategy session will be posted in early to mid-September. So start thinking of submissions for the Zacks mailbag and portfolio makeover segments.
Welcome to Top Stock Picks segment. I'm Neena Mishra, and my top stock pick today is Shopify, ticker symbol SHOP. Now, Shopify is a Canadian company. It's a relatively new company. It went public in 2015, and its shares are listed both on the Toronto Stock Exchange and the New York Stock Exchange. Shopify provides businesses a number of tools to digitize their operations. Now, we know that e-commerce was one of the biggest beneficiaries of the pandemic, because consumers who were stuck at home, they were shopping online for all their needs. But actually, the market share of online sales has been rising for the past few years. The trend only accelerated during the crisis. And in fact, we may see a permanent shift in consumer behavior toward online shopping even after the health crisis is over. And for now, the pandemic is far from over. We know that the Delta variant is resurging, and that could keep some people continue to shop online. And due to the transformation in shopping habits of consumers, retailers are moving online at an incredible pace, because they want to survive and thrive in this new normal. And many smaller businesses still do not have an online presence, and Shopify is helping such businesses. And it actually works with some of the bigger brands too, in addition to small companies. And now it has more than 1.7 million total merchants using its platform worldwide. The company reported excellent results, beating both on the top and bottom lines, and sales topped $1 billion for the first time. And in fact, the company has been trouncing its estimates ever since its IPO. And I wanted to show some charts on Zacks.com to show how the company has been crushing its estimates. So as I mentioned, this is a Zacks rank number 1 strong buy stock. It is a very expensive stock. In fact, one of the most expensive stocks on the market. You will see that forward earnings multiple is 333 times. But investors do not mind paying for growth, so that is why I think the stock can continue to go up. Now, looking at the earnings estimates, you will see that earnings estimates have gone up significantly after the company reported. And looking at the surprise history, you will see that company has just been trouncing estimates, more than double estimates for so many quarters. And looking at the price consensus and earnings chart, you will see that it continues to beat estimates since its IPO. Now, I also wanted to show you something on Shopify's website. If you go to investor presentations, you will see that Shopify currently has less than 9% share in the e-commerce market, whereas Amazon has 39% share. And this suggests that Shopify still has a lot of room to grow. And in order to continue to grow, the company has expanded its partnerships with Google, Facebook, Pinterest. It is also building warehouses and logistics networks to compete with Amazon. Now, as I mentioned, the stock is very expensive. And in fact, the stock sold off slightly after reporting results because Shopify cautioned investors again that its revenue will continue to keep growing in 2021, but not at the pace that it experienced last year. And that is something which is to be expected. So I think any dip in the stock price provides an opportunity to long-term investors to buy this stock. And now I will hand it over to Dave for his pick, his top stock pick.
Well, thanks, Neena. And here I have my top pick for the month. It's ticker ASIX, AdvanSix. Let's go ahead and take a look. AdvanSix is in the chemical specialty industry, which ranks in the top 42% of our Zacks industry ranks. So not exactly a top industry, but this is a top stock. It's a Zacks rank #1 strong buy. Now take a look at these Zacks style scores. We have a value style score of A, a growth style score of B, and a momentum style score of A to help it round out with that VGM composite score of A. So in terms of Zacks rankiness, we got a couple of great things happening. Zacks rank #1, VGM composite A. That's a great 1-2 combination. If you take a look at the Zacks consensus estimate for the current year, there's been a lot of positive movement, and that's the reason why it's a Zacks rank #1 strong buy. So current year estimates are up from $3.17 about 90 days ago, all the way up to $4.27. That's a really big jump. You're talking 33% there. Next year's number is up from $3.40 all the way up to $4.02. So percentage-wise, not as much, and obviously there's not growth year over year, but you got to think a fantastic year this year. That's really where all the momentum is in this one. Count them, 6 consecutive quarterly earnings surprises for AdvanSix. The last earnings surprise came in at 41% to the upside, and that's the reason why it is in Surprise Trader, because big-time surprises, and it's been on the move. Last thing I want to look at here is our price consensus and EPS surprise chart. Here you can see those 6 in a row, but notice how earnings rolled over and sort of troughed and bottomed in 2020, then started to tick up. We really like seeing that move, and as long as that continues, the stock should continue to rock and roll. Thank you, everybody, so much for watching this month's edition of the Zacks Ultimate Strategy Session. We will see you all next month. Goodbye.